Hi, good morning, everyone. We are starting the webinar now. Okay, earnings season. This is Richard speaking, analyst for transport and logistics. So earnings season is in full swing now. So as usual, we are going to present our update for the counters that we have coverage on that have announced their results last week. So I'm going to start off with Cash Logistics Trust, which announced their full year results last week. We currently have an accumulated rating on cash with a target price of $1.30. Last week closing price was $1.18.50. So you can see from the slide results at a glance. For the full year gross revenue, they went up by 2.3%. Due to growth from rental reversion and inbuilt rental escalations. Net property income also increased despite the higher expenses, and distributable income also increased. This was due to increase in the NPI coupled with lower financing costs. At the DPU level, there was a marginal decline in the DPU because of the increased unit base. They had a placement earlier last year for the acquisition of Precise2. These two tables are showing the current status of cash as you compare them against the other industrial REITs listed in Singapore. So what we see at the end of the FY is that cash has maintained its dominant position among the industrial REITs. They have the second highest occupancy in the whole industrial REIT sector, near full occupancy at 97.9%. Sorry for the typo. And they have a second longest WALE in the sector at 4.1 years. The outlook for cash in this FY15 from January to December is that they'll continue to deliver a stable performance. This is due to their portfolio of properties with good locations which are near to the ports and airport, and the superior design of their portfolio, which is of the ramp-up type warehouses. Moving on to SMRT. SMRT also announced their third quarter results last week. We currently have a reduced rating on SMRT with a target price of $1.57, and last week's closing price was $1.75. You can see that for their fair revenue business, most of it saw higher growth in their revenue due to higher ridership and higher average fare, except for LRT, but LRT is only a small component, only 2.4 million in revenue compared to the rest of the business, so it's not very significant. For their taxi business, they had a higher rental income from newer and larger fleet. So on a whole, for SMRT revenue, you saw broad-based growth across most segments. Next, we look at their EBIT level. MRT saw improved profitability, while bus business reduced their losses from 8.7 million in loss from the same quarter last year compared to 0.5 million loss in this quarter. Taxi saw some dip in their EBIT margin as well. This was due to increases in expenses from their life cycle overhaul works, as well as some write-offs when they dispose of the older taxis. On the whole, for their PATMI, there was a reduction in losses, primarily due to the bus business where it pared their losses. So you can see from here, bus business improved by about, still loss-making, but improved by about 8 million, and that difference was translated down to their PATMI level as well, which is about 8 million here. difference of 8 million. So the key highlight for this quarter for SMRT is that the bus model transition will take place in May 2016 instead of September 2016. SMRT and SBS Transit have a bus service operator license to operate the bus services, and actually the license expires in end of August 2016. So it was originally expected for the new model to take place in September, but it was announced in SMRT's recent results release that it's going to transition in May. So that's 4 months earlier. Why we do not like SMRT at the moment is that it doesn't have any cash generating ability. They are using debt to fund their capex, and actually they use debt to pay their dividends in the previous quarter as well. Their cash flow from operations is not able to support their capex requirements. Okay, moving on to the main presentation. Today we're going to speak on Cash Logistics Trust, which we initiated coverage on last week. This is the agenda for the presentation. First will be a REIT snapshot, followed by the investment thesis, REIT background, peer relative valuation, investment merits, and then wrap up with the risk factors. So this is a snapshot. Target price $1.30. We're forecasting a DPU of about 8.3 cents for FY15. 52-week range was from $1.07 to $1.24. Market cap 926 million at the moment, so it's close to 1B already. Okay, so we'll start with the investment thesis, top down. First of all, we look at whether there's going to be GDP growth for Singapore. So yes, there is. MTI has forecasted 2 to 4% GDP growth for 2015. Next point, Singapore is the logistics hub of the region. 17 of the top 25 third-party logistics providers have set up regional HQ or hub locations in Singapore. What the competitive strength for Singapore is that its connectivity, stability, and infrastructure. So cash will be a key beneficiary of Singapore's logistics hub status, because if you're doing logistics, you're going to need warehouses, and cash has a portfolio of warehouses, 12 completed already in Singapore, with their 13th Singapore property under construction now, and they have one in Shanghai, which is a chemical storage warehouse. Now we look at the relationship between REITs and the interest rate. So in the first graph here, this is the blue line represents the S-REIT index, while the red line is the 10-year government bond index, 10-year government bond yield. So there's not much correlation in the behavior between the REIT index and the government bond yield. But when you look at this chart, the chart at the bottom, which is the REIT index together with the 3-month SOR rate. So why we choose a 3-month SOR rate? Because the 3-month SOR rate is actually the borrowing cost of the REITs. Their floating rate is pegged to the 3-month SOR. So what you see is that as the borrowing cost increased from the period from 02 to 07, the REIT index also went up as well, and both came down during the global financial crisis. After the global financial crisis, the borrowing cost has been kept low to stimulate the economy, and that has worked with the REIT index going up. What we are seeing now is that the borrowing cost is now starting to creep up as well, just like in the past year where it was a bull economy. So we are expecting that the REIT index would continue to rise in tandem with the improving economy. So what we say is that the REITs will appreciate in a rising interest rate environment as well, because they participate in an expanding economy through rising rental rates and through the demand by businesses for warehousing space to store their inventory. The distinct competitive advantage for cash is its managerial expertise. The REIT manager and property manager are joint ventures between ARA Asset Management and CWT Limited. So both of them are listed on Singapore Exchange as well. ARA is an established real estate fund manager and one of the largest REIT manager in Asia with a market cap of 1.4 billion. CWT is also a leading logistics player experienced in developing and managing warehouses. Its market cap is about 1 billion as well. So you can see that the REIT is managed by two big players in the market for asset management and logistics. Next is cash has a superior portfolio of properties, and testament to this is their stable income visibility. So why the portfolio is superior, they have good location. The warehouses are located near to the ports and airport, and the design of the warehouses are modern. They are ramp up versus cargo lift, and they have a long WALE of 4.2 years and near full occupancy. Cash also has an attractive dividend yield, which we are forecasting about 7% for this FY. This is a portfolio overview. So they have 13 plus 1. One is under construction at the moment. So they have 12 completed and operational warehouses in Singapore at the moment. From here, this map, you can see that they are clustered around the west and the east. Around the west is near Jurong Port. That's why it's a good location. And on the east, they are near Changi Airport. This is the property in Singapore that's currently under construction, and it will be located here at the Tampines Logis Park. This is a snapshot of their portfolio. So as I mentioned, 12 in Singapore which are completed and operational, one that's under construction now, and one in Shanghai. Total GFA is 5.1 million, and when the DSC ARC is completed, it will increase to 6.1 million square feet. So this is roughly about 20% increase in their GFA. So you can tell that this new warehouse is going to be a significant development for them. As I mentioned before, occupancy almost full, 97.9%. They have a mixture of master, lessee, and multi-tenanted buildings. Average building age 6.8 years. This is actually quite new relative to their nearest peer competitor, which would be Mapletree Logistics Trust. The average age of the buildings located in Singapore for Mapletree Logistics Trust is roughly about 11 years. So Cash's buildings are newer and they have a more modern design. If you look at the annual report for Mapletree Logistics Trust, a lot of their warehouses are still of the legacy design of the cargo lift, which is not the desirable feature at the moment. Mentioned before that they have 4.1 years WALE, which is the second highest for the industrial REIT sector. And yeah, here 10 of their buildings have the ramp-up design, which is the modern design now, and only 2 are still using the cargo lift. They have inbuilt rental escalations of 1% to 2.5%. So this would give them a stable growth for the portfolio in terms of their gross revenue. Now we look to their growth potential of their portfolio. So as you know, the REITs, there's limited, they have limited scope for construction and development, so they require help from the sponsor to provide them a pipeline of properties for them to acquire so that they can grow their portfolio. So they have this ROFR agreement that they've been granted, which has been granted by their sponsor CWT and CMP Limited for properties located in Singapore, China, and Malaysia. So within this portfolio of ROFR properties, there are 15 of them and approximately 5.7 million square feet in GFA. These are a selected 8 which Cash lists out in their fourth quarter presentation slides. So you can see these are the Singapore ones, this is the Malaysia one, and this is the one that's located in China. You'll notice that quite a number of them are actually occupied by their sponsor, which is CWT as well. Okay, this one, if these two tables shown them earlier, but this is a bigger version of them, so you can see it more clearly now. So Cash has maintained its dominant position among the industrial REITs. As I mentioned before, they have the second highest occupancy for the sector. The demand for quality properties drives this occupancy. And high occupancy means that their assets are being fully utilized, and this results in good income generation. The second point about their dominant position is that they have the second longest WALE for the sector, seen here, 4.1 years, compared to the rest of the sector. This long WALE results in stability and predictability to their income flow. We'll talk more about their lease expiry profile. So actually in 2015 and 2016, there's quite a large supply of warehouses coming onto the market. But if you look at the lease expiry for Cash, they only have 11% and 16% of their lease expiry in 2015 and 2016. So they are not that they're not going to be so significantly affected by the supply of warehouses that's coming onto the market. Moreover, for Cash, their buildings are modern. They have that modern design of the ramp up, so they'll be able to compete with the new warehouses because they're of equal quality design specifications. Next, about their debt profile. So they recently refinanced their debt. If you look at here, previously they had debt expiring in 2015 and 2016, but that has been shifted over already when they refinanced, shifted over to 2018 and 2019. Their loans was at 375 million, but they refinanced it now to 400 million. This 97 million you see here is specifically for the DSC ARC construction. Okay, I'm going to speak more on their new warehouse, the DSC ARC, which is the DHL Supply Chain Advanced Regional Center. It is a built-to-suit development where they are working together with their sponsor CWT to design and build this mega warehouse specifically for DHL. This is a snapshot of the DSC ARC. So it will be located at Tampines Logistic Park. As I mentioned before, it's a modern ramp-up design, and there'll be 2 blocks. Currently, about 66% of the work has been completed as of the end of 2014. So this gross area is almost 1 million square feet, which, as I mentioned earlier, would increase their portfolio GFA by about 20%. It's expected to TOP in the second half of this year, so expect full year contribution coming from 2016 onwards. Okay, now we look at the relative valuation We believe that the closest peer to cash is actually Mapletree Logistics Trust, which also holds a portfolio of properties used exclusively for warehousing needs. If you look at price to NAV, they are on par, 1.23 and 1.21, so that's a negligible difference in their price to NAV valuation, relative valuation. But you notice that the yield for Cash Logistics Trust is actually 100 basis points higher than Mapletree Logistics Trust, which is 6.2%. So in that sense, we think that cash now is relatively undervalued compared to Mapletree Logistics Trust. Okay, this is actually a wrap-up of the investment thesis which we crystallize into the investment merits for cash. So firstly, it's the direct exposure to Singapore's warehousing sector, and it rides on Singapore's competitive strength as the regional logistics hub. For the REIT itself, it has a distinct competitive advantage over other REITs in the sense of their managerial expertise. The REIT manager is a 60-40 JV between ARA Asset Management and CWT, while the property manager is a 60-40 JV between CWT and ARA. What you see is that ARA has the expertise of managing the REIT at the portfolio level, while CWT has the expertise of managing the warehouses, operational details, and design at the individual level. So that's why they have split their expertise up in these ratios for their JVs. Next is the stable income visibility. So as I presented earlier, they have a long WALE, 4.1 years, and near full occupancy of 97.9%, which is both of which are the second highest in the industrial REIT space. So they are one of the dominant REITs currently for industrial REITs. There's sustainable portfolio growth. They have a pipeline of 15 ROFR properties from their sponsor, and there's an attractive dividend yield. We are forecasting 8.9 cents for FY15, which translates to about 7% yield. Lastly is the risk factors. So refinancing risk is the first risk. As you know, the REITs are highly geared, so it's very important for their ability to refinance their debt. Macroeconomic risk, just like every other equity and REIT, it's also subject to macroeconomic risk. So economic and trade slowdown would dampen the demand for logistic-related services. Rental reversion and occupancy risk. So we've identified some near-term headwinds in that 2015 and 2016 there will be a large supply of warehouses coming up. But we've also identified that they only have 10%, 11% and 16% of their leases up for expiry in these 2 years. So there's some mitigation of this risk already. And the thing is that for cash, their buildings are of a good location and they are having a modern design which are also comparable to the new warehouses that's coming up. Next is the regulatory risk. So there might be some government rules on land use and tenants, and this could affect growth prospects and their ease of securing new tenants in complying with a new ruling from the government. And next is a unit holder dilution and value destruction. So for REIT, there will be more frequent calls for capital compared to stocks. This could come through placement and rights issue. And also the acquisition might not be DPU accretive, but we don't think that this would be a big issue for cash, as you can see that actually DPU has been accretive in their acquisitions in the past. So to conclude, the investment action for cash is that we have an accumulate rating with target price of $1.37, closing price of $1.18.5 from last week. What we like about cash is that there's an attractive forecasted dividend yield of about 7%, and this is supported by their stable distributor income from the demand for their high quality properties in their portfolio. Okay, we've come to the end. Welcome your questions, and we will try our best to answer your questions. Yeah, the first question is about a comparison between master lease and multi-tenant lease. You can't, it's not appropriate to describe whether which is inferior. The structure is different because in the master lease are they tend to have a longer tenure compared to the multi-tenant lease, so there's some stability in the master lease. And if the market rental is actually falling and you recontract your individual tenants, you actually recontract them at at a lower rate than previously, and the master lease would actually be at a higher rate. But this, having said that, also it works both ways. If the rental rate is rising, if the market rental is rising, then of course the individual multi-tenant lease would be able to track the rising rental market better. So it works both ways, and it's not fair to think of what is inferior, whether one is inferior to the other. They have their own unique features which would even out in the portfolio. Yeah, there's a question, does cash have a big sponsor? This was mentioned earlier. The sponsor for cash is CWT. So CWT market cap 1 billion. So I think the answer is yes. That does cash have a big sponsor. The sponsor is CWT and is a very experienced logistic player with experience in developing, designing, building, and managing their own warehouses. There's a question about the price and rental of warehouse according to the URA index. One thing you got to take note about that index is that actually it's an average of gross rental and triple net lease. So it's not a very it's not a definitive index, and you got to take it a pinch of salt. Yeah, there's a question about price to NAV of 1.2 for cash. Actually, is not very high. If you look at our initiation report, there was we also provided a chart for the price to NAV, and it's somewhere near the historical average now. Yeah, there's a question about peer comparison chart. Let me go to that chart. About other peers trading at lower valuation. I'll say that for higher yield, you're taking on the risk of that particular REIT. The market will value the yield according to the perceived risk and outlook for the business. So you're not you're not getting the higher yield for free. If you look at, I mean, in the question we have specifically met, if we look at this chart and the highest yield Fiverr, but you have to know that there are if you like the yield, but you should go and look into what properties they are holding. Currently, they have about five, I think, five or six, and so in terms of diversification, they are not as diversified compared to the other REITs. And you have to look at the portfolio of properties that they have, where their locations. Are they at a good location? Is it a modern building? Does it have amenities? Investing in REIT is not so straightforward as just looking at the yield. Yeah, there's a question about the interest rates. So, I mean, there's a lot of comparison where people compare the REITs with the 10-year government bond. But the thing, and then they'll go on to compare the yield spread. But the thing that we'll point out is that a REIT isn't a fixed income instrument, and if you want to, and the key issue here about the worry about REITs is borrowing costs, not the risk-free rate, right? So that's what figure 2 on this page shows. It's the REIT index compared with the borrowing costs that the REITs are looking at, which is the 3-month SOR rate. There's a question on transport sector rally. Yeah, it could be due to the transition for the bus, and also I think it's contributed by the perception of the market for lower fuel costs as well, which would improve the earnings for the public transport operators. Yeah, hi, there's a question. Is GLP a better buy than cash? Firstly, they are two totally different investment vehicles. One is a REIT, one is a warehouse operator. So their risk profile and returns profile are totally different. Is you have to decide what are you going for. You going for stable returns from dividend, or do you want to have a play on um, a warehouse operator and capital gains from that? Yeah, okay, so if there are no further questions, we are going to end the webinar here. Thank you for tuning in. Hope to see you again next week.